A good week of performance in the equity markets didn't translate into better flows for equity mutual funds. Hi, I'm Jeff Turnahoy, and welcome back to Lipper's Fund Flows Insight Report. For the week ended April 10th, 2013, the long-term mutual funds industry saw about $4 billion in net inflows this week, while money markets had about $8.6 billion in outflows. Let's take a look at our macro groups and see where the activity was. Starting off at the top, equity funds, again, only about $2 billion in inflows this week. They were slightly ahead of taxable fixed income funds, which had about $1.9 billion. Municipal debt funds continued to sink a little bit. They had about $618 million in outflows. And finally, once again, money market funds had outflows of $8.6 billion. Well, as I mentioned, it was a decent week for equity performance, with the market up about 2% on this week. It's been charting and threatening to get close to that 15,000 level on the Dow, but the enthusiasm for equity mutual funds is really waning over the past several weeks. In fact, several of the past weeks that we've seen the trend moving lower and lower as far as weekly inflows go. Let's take a look at the equity funds data and see what I'm talking about here. So even though performance in the market, again, was up 2%, the 4-week moving average continues to drop and is now at about $2.6 billion a week. It was twice that level to start the year. Very light activity, though. When we're looking at inflows and outflows through all the different equity categories, there was not a whole lot of activity at the end. No one really lost a ton of money, and no one really took a lot in. Domestic funds continued to play second fiddle to international funds. Domestic funds were the recipients of about $800 million this week, while non-domestic equity funds saw about $1.2 billion in inflows. Emerging markets, of course, were at the front of everyone's mind. They took in about $527 million, which was tops in this group for weekly inflows data. It's a little interesting as well to see that long-short equity funds were the second place finisher. Although they only took in about $317 million, it was rather interesting to see that advisors, perhaps some direct investors as well, are taking a second look at long-short and perhaps other alternative strategies as a way to mitigate some market volatility or perhaps the uncertainty whether or not the market has reached a peak. We'll be finding out later on, I guess. The next group to take a look at is equity ETFs. This week, they acted a little bit differently than their mutual fund counterparts. We saw about $600 million in total outflows from this group. Leading the charge was the SPDR Gold. Gold has tracked lower throughout this year, and this was no surprise to see the ETF GLD be among the categories worst for inflows, or for outflows, I should say. EFA and IWF also saw outflows. We also saw Japan in play as far as inflows go. The EWJ gathered about $662 million this week. I have a feeling we're going to be hearing a lot more about Japanese equity in the weeks and months to come. Finally, the Dow Jones and S&P 500 versions came in slightly differently. We saw the SPDR Dow Jones more attractive than SPDR, SPY. So maybe a bit of technical trading on that side. The next group we'll take a look at is taxable mutual funds. Again, they had about $1.9 billion in inflows this week. Roughly the same as last week. Given the size of this group, I'd say it was about the same number. Loan funds continued to dominate inflows. They had about $838 million this week, taking their year-to-date totals to about $16.5 billion, way ahead of high yield funds, by the way. Short investment grade was way behind in second place. They had about $187 million in inflows. Clearly, all the attention right now is on loan funds, taxable mutual fund investors. I'm not finding a whole lot else out there to be confident about. And the reason why might be found in the behavior of fixed income ETF investors. They added about $2.1 billion this week. It's a very good number. It's their best in 4 weeks in. The short Treasury trading was dominating some of the inflows activities. TBT, the ProShares Ultra Short 20-year plus Treasury, saw inflows of over $500 million this week. That's their best week of inflows ever, so it stands to reason that they're going to dominate some of these numbers here today. So while there were a lot of inflows into taxable ETFs, Almost 20% of that was in the short Treasury play. There was probably about $450 million total devoted to shorting fixed income in the ETF space this week. Next group to take a look at is municipal debt funds. They've been on a slide recently. $618 million is the worst outflow figure of this year. This is their 6th consecutive week of outflows. This comes despite pretty good, in fact, very good performance, 25, 30 basis points of performance over the last couple of weeks. You would think that's enough to keep people interested. Evidently, other issues are keeping them away, or at least starting to pare back. President Obama has made statements in his budget proposal that perhaps the tax exemption status of municipal debt should be scaled back. This has spooked some investors. Again, nothing is done, and who knows what the future may hold in Washington as far as getting a deal done on budget concerns. We may see no activity on that side at all, but time will tell. Finally, the last group to take a look at is money market funds. They had outflows of about $8.6 billion this week. Yeah, although it shades the other numbers quite a bit, this is a pretty small figure for an industry with over $2.5 trillion to its name. So overall, not much to speak of here. We saw fairly similar behavior between institutional and retail money market investors. The institutions taking out slightly more, about $4.9 billion versus $3.6 billion removed from retail money market accounts. Well, that'll do it for this week. Thanks for joining us, and if you'd like to get more information, please join us online at lipperusfundflows.com, and we'll see you again next week. Thank you.